There's a provision tucked inside the Internal Revenue Code that would sound almost too generous if it weren't written in black and white on the IRS's own publications. If you're 70 and a half or older, you can direct up to $108,000 from your traditional IRA to a qualified charity. And that entire amount bypasses your adjusted gross income completely. It doesn't show up as taxable income. It doesn't count toward your combined income for Social Security taxation. It doesn't push you into a higher ERMA bracket for Medicare. It doesn't trigger the net investment income tax. The money simply leaves your IRA and arrives at the charity, and on your tax return it appears as if it never existed. Most retirees have never heard of it. Most tax preparers don't mention it unless specifically asked. And the retirees who do know about it use a smaller version of it without realizing the one-time expanded option exists at all. We're going to unpack what it actually is, how the expanded limit works, and the traps that have cost families thousands of dollars even when they thought they did everything right. Before we go deeper, the standard reminder. This video is for educational purposes only and is not personalized tax, financial, or legal advice. Consult a qualified professional for guidance on your specific situation. The numbers I'll reference are current to the 2025 tax year based on IRS Publication 590B and Secure 2.0 provisions. They change with inflation every year, so the exact threshold when you act may differ. What won't change is the structure of the rule, and once you understand the structure, the strategy becomes obvious. The baseline qualified charitable distribution, known as a QCD, allows IRA owners aged 70 and a half or older to transfer up to $108,000 annually from a traditional IRA directly to a qualified 5011C3 public charity. Indexed to inflation, this limit started at $100,000 when the rule was first made permanent. For 2025, it sits at $108,000. For 2026, it's projected to climb again. The transfer must go directly from your IRA custodian to the charity. If the money touches your personal account, even briefly, the transaction is disqualified and the entire withdrawal becomes taxable income. That's trap number one, and it destroys the benefit more often than any other mistake. But tucked inside Secure 2.0 is something most retirees have never heard about. A one-time election allows you to direct up to $54,000 of your QCD to a split interest entity, such as a charitable gift annuity, a charitable remainder unit trust, or a charitable remainder annuity trust. This $54,000 counts against your annual QCD limit, so it isn't additional money. But it lets you convert a portion of your IRA into a lifetime income stream while still receiving the tax exclusion. For a retiree who wants to support a charity and also retain an income benefit, this is a tool that didn't exist in this form before 2023. And because it's a one-time election, you can only use it once in your lifetime. Most advisors don't even mention it. Most clients never ask. Let me walk you through why the QCD matters so much in practical dollar terms. Beatrice, a retired librarian from Ann Arbor, Michigan, had a required minimum distribution of $38,000 from her traditional IRA. She was already in the 22% federal tax bracket. She also tithed consistently to her church and supported 2 local charities, writing roughly $12,000 in checks each year from her taxable brokerage account. Her CPA had her taking the full RMD, paying the tax, and then deducting her charitable giving on Schedule A. Except Beatrice was taking the standard deduction because her itemized total didn't clear the higher standard deduction threshold for seniors, so her $12,000 in giving was producing 0 federal tax benefit. When a new advisor introduced her to the QCD, the math shifted immediately. She redirected $12,000 of her RMD directly to her church and chosen charities through her IRA custodian. That $12,000 was excluded from her adjusted gross income. It satisfied part of her RMD obligation. And the rest of her RMD, now $26,000, was the only amount that showed up as taxable. Her federal tax savings were roughly $2,640 in that single year. Her state tax savings added another $480. Across 5 years of consistent QCD use, the running total exceeded $15,000 of tax she would otherwise have paid, and she was giving the same amount to the same charities. The only difference was the routing. Now let's talk about the Social Security and Medicare ripple, because this is where the QCD becomes enormously valuable for retirees in the middle income zones. Social Security taxability is calculated on combined income. If your AGI is inflated by a large RMD, more of your Social Security becomes taxable. By using a QCD to reduce your AGI, you can sometimes move from having 85% of your Social Security taxed down to 50%, or in some cases, 0. For a retiree receiving $32,000 of Social Security, dropping taxability from 85% to 50% means $11,200 fewer taxable dollars. At a 22% marginal rate, that's another $2,460 of tax savings on top of the direct QCD exclusion. Medicare IRMA is the next piece, and this is where the planning becomes sharp. IRMA, the income-related monthly adjustment amount, adds a surcharge to your Medicare Part B and Part D premiums based on your modified adjusted gross income from 2 years prior. For 2025, a single filer with MAGI above $106,000 pays higher Part B premiums. For a married couple filing jointly, the threshold is $212,000. The surcharges climb in tiers. At the top tier, a married couple can pay roughly $8,000 more per year. In combined Medicare premiums compared to the base rate, a single $40,000 RMD could push you from the base tier into the first IRMA surcharge tier. A QCD of the same amount could keep you below the threshold entirely. Walter and Eleanor, a retired accountant and a retired nurse from Scottsdale, Arizona, ran into this exact trap in the year before. Their advisor introduced them to the QCD. They took a $60,000 RMD, sold an appreciated stock position to fund a kitchen remodel, and triggered a large capital gain. Their MAGI that year landed them in the third RMA tier. 2 years later, their combined Medicare premiums were over $7,000 higher for a full 12-month period. They were shocked. The IRMA surcharge is calculated on a 2-year lag, so the year you make the mistake and the year you pay the surcharge are not the same, which is why retirees don't connect the cause to the effect until long after they could have done anything about it. Their new advisor restructured the following year. The couple redirected their full RMD through a QCD, which they had been planning to give anyway through a donor-advised fund. They sold a smaller portion of the appreciated stock and had used a charitable remainder trust for the rest. Their MAGI landed back in the base tier. 2 years later, their Medicare premiums dropped back to the base rate. The total estimated savings over their remaining lifetime across IRMA, Social Security taxability, and direct federal income tax exceeded $31,000. One strategy, several ripples. Here's trap number 2, and this one catches the most careful retirees. The QCD must come from a traditional IRA. It cannot come from an active SIPP IRA, a simple IRA in its contribution year, or a 401k. If you have retirement money still parked in a 401k, and you want to do a QCD, you first need to roll it over to a traditional IRA. That rollover takes time. Custodians have processing windows. Year-end QCDs often fail because retirees try to execute them in December and the rollover doesn't complete in time. The workaround is to plan the rollover in the first quarter, let it settle, and then execute QCDs throughout the year in measured amounts. Trap number 3 involves the paperwork. Your IRA custodian will issue a Form 1099-R showing the total amount distributed from your IRA. It will not specifically mark which portion was a QCD. That's your responsibility on your Form 1040. You report the total on the pension and annuity line, then subtract the QCD portion and write QCD next to it on the return. If your tax preparer isn't paying attention, they may include the QCD amount in your taxable income by mistake. Harold, a retired electrician from Manchester, New Hampshire, had his return prepared by a volunteer preparer one year and discovered 3 months later that a $20,000 QCD had been reported as fully taxable. He had to file an amended return using Form 1040X to recover the tax paid. The correction worked, but it cost him 2 months of paperwork and the mental weight of a process he didn't need to go through. Trap number 4 is timing relative to your RMD. Your RMD for the year is calculated on December 31st of the prior year's balance. The first money out of your IRA in any calendar year counts towards satisfying your RMD, regardless of whether it's a QCD or a regular distribution. This is a good thing if you want your QCD to reduce your taxable RMD, but it means you need to front-load your QCDs before taking any other distributions. If you take a taxable distribution in March for cash flow and then do a QCD in October, the QCD counts towards satisfying your RMD, but the March distribution is still fully taxable. Some retirees lose the benefit by sequencing in the wrong order. Trap number 5 involves the charity itself. Not every organization qualifies. Donor-advised funds, private foundations, and supporting organizations are specifically excluded from QCD eligibility. This surprises a lot of retirees who have built a donor-advised fund for flexibility. You can't route your QCD through your donor-advised fund. It must go directly to a qualifying 501c, IT6 public charity. You can, however, use the expanded one-time $54,000 provision to fund a charitable gift annuity or charitable remainder, trust, which are the split interest entities I mentioned earlier. Those are the narrow exceptions carved into Secure 2.0, and they're the reason the one-time election exists. Let me explain the charitable gift annuity path, because for income-sensitive retirees, it's powerful. You transfer up to $54,000 from your IRA directly to a qualifying charity in exchange for a lifetime income annuity. The charity invests the funds. You receive fixed payments for the rest of your life, often at rates that exceed commercial annuity rates for your age. A 75-year-old might receive payments at a 6.5% annual rate or higher, depending on the charity's published schedule. When you pass away, the remaining value goes to the charity permanently. The original transfer counts against your RMD and is excluded from your AGI. The annuity payments you receive each year are fully taxable as ordinary income, but by then the AGI pressure during your early 70s has already been reduced. Ruth, a retired postal worker from Cedar Rapids, Iowa, used this exact structure. She transferred $50,000 from her IRA to her alma mater through a charitable gift annuity at age 75. Her annual payment was $3,250 for life. The $50,000 was excluded from her AGI in the year of transfer, which kept her out of the first IRMA tier and reduced the taxability of her Social Security. Her long-term income stream was secured, her alma mater received a future gift, and her lifetime tax picture improved meaningfully. She used the one-time election, so she can't repeat this structure, but the standard $108,000 QCD remains available to her every year going forward for direct charitable giving. Now let's talk about the strategic timing of QCDs across your retirement arc. The earliest you can execute a QCD is the day you turn 70 and a half. Not 69, not 70, but 70 and a half specifically. RMDs under current law begin at 73 for most retirees, climbing to 75 by 2033 under Secure 2.0. That creates a 30 to 48 month window where you can do QCDs before you're even required to take RMDs. During this window, a QCD reduces your IRA balance permanently, which reduces every future RMD calculation for the rest of your life. It's a proactive shrinking of future taxable income, not just a reactive tool for the year you're in. Nancy, a retired nurse from Tampa, Florida, started QCDs at 70 and a half, 2 years before her RMDs began. She gave $15,000 per year for those 2 pre-RMD years, reducing her IRA balance by $30,000. When her first RMD landed, it was calculated on a smaller base, which reduced her RMD by roughly $1,100. That $1,100 reduction carried forward every year as her IRA continued growing on a smaller foundation. Over a 20-year retirement, the compounding effect of those pre-RMD QCDs reduced her cumulative taxable RMDs by well over $20,000. Small actions in the pre-RMD window compound heavily. Here's a trap that affects couples specifically. Each spouse's QCD limit is $108,000. For a married couple where both are over 70 and a half, the combined annual QCD capacity is $216,000. But each spouse must execute their own QCD from their own IRA. You cannot pull the limits. You cannot do a QCD from your spouse's IRA to help their tax picture. If one spouse has a much larger IRA and wants to reduce their RMD through charitable giving, they're constrained to $108,000. The other spouse's unused capacity doesn't transfer. Planning around this requires coordination before year end, not after. Let me add something about the one-time expanded election that most people miss. The $54,000 limit for split interest entities is indexed to inflation, like the main QCD limit. For 2025, it sits at $54,000. It will grow each year. If you're planning this strategy for a future year, the limit will likely be higher, but the one-time nature is absolute. You can execute the expanded election in one calendar year only. You can split it among multiple split interest entities in that 1 year if you want, but the total across all entities cannot exceed the $54,000 cap, and you cannot revisit the election in later years. Arthur and Joyce, a retired machinist and a retired school teacher from Lincoln, Nebraska, used the expanded election together. Each of them directed $54,000 to a charitable remainder annuity trust in the same calendar year, naming their 3 grandchildren as co-beneficiaries of the remainder. Their combined one-time transfer totaled $108,000. It removed that amount from their combined IRAs permanently, reducing future RMDs. It provided a lifetime income stream during their retirement, and it left a significant legacy to their grandchildren, structured through the trust. Their advisor coordinated the timing, so both transfers happened in the same tax year, maximizing the planning window. If you want to start thinking about whether a QCD fits your situation, here's the simple framework. First, are you 70 and a half or older? If no, the door isn't open yet, but note the date for planning. Second, do you have a traditional IRA with meaningful balance? If the answer is yes, the tool is available. Third, are you currently giving to qualifying charities from your taxable accounts? And are you taking the standard deduction? If yes, you're likely losing the tax benefit of your giving entirely, and a QCD would capture it for you. Fourth, do you face IRMA pressure, Social Security taxability pressure, or bracket creep? If any of these apply, a QCD is one of the most surgical tools available to reduce AGI without reducing your spending or giving habits at all. Here's the quiet reality most retirees miss. Charitable giving in retirement is often assumed to be a matter of personal generosity, disconnected from tax strategy. But the IRS, through the QCD structure, has explicitly invited you to align the two. If you're going to give anyway, routing the gift through your IRA preserves the tax benefit that the standard deduction has quietly stripped away from most seniors. If you're going to take an RMD anyway, satisfying part of it through a QCD converts a taxable event into a tax-free transfer. The law was designed this way intentionally. Using it isn't aggressive planning. It's the plain use of a provision Congress built on purpose. If you found this useful, the best thing you can do is sit down with your own IRA statements, pull out your last tax return, and see whether your charitable giving last year produced any federal tax benefit at all. If it didn't, and you're 70 and a half or older, you already have an answer sitting in front of you. Bring it to a qualified advisor and ask specifically about QCDs and the one-time split interest election under Secure 2.0. Most advisors will know the terms. Some won't have walked a client through it recently. Ask enough questions to be sure. If you subscribe and stay with this channel, I'll keep walking through the quiet tools the tax code hides in plain sight. The code is 4,000 pages long on purpose. Someone has to translate it for you. That's exactly what we do here, one careful rule at a time.